First of the three C's is co-investment. Co-investment is just so important to us. When I say co-investment, I mean alignment. We want our investment specialists to be aligned with our investors and clients. It's just a non-negotiable for us. And too often in the funds management industry, fund managers out there just want to grow the fund as large as they can because they're charging a fee over funds under management. And that's what happens in these larger houses. They get too big and then performance actually hampers as a result. So what we like to see are managers that are highly aligned to performance, first of all, so they're remunerated on performance, they're getting paid after they've generated profits for our investors. But secondly is how much skin in the game they actually have. And that's very important to us. When you think about advising a normal investor or client, you're sitting there with an asset class allocation, you're allocating some capital to equities, some to fixed income, some to bonds, cash, etc. When we look at some of our fund managers, they often have nearly all of their net personal wealth invested in their own strategy. So they're concentrated. They sweat when our investors sweat. So when they are actually making an investment decision, they're making that investment decision with their capital as well, not just our investors' capital. But also, if they have most of their wealth in their strategy, again, come into capacity, which is one of the other important C's. With capacity, they know they want to cap out how much they're going to manage under their fund, because as you get larger, you become less flexible and then performance tends to drop away. So the manager being aligned with their own personal wealth in the fund, plus having that commitment to cap the amount of funds they're prepared to take into that strategy is very important. And most managers these days will tell you on day one, we're going to cap the fund at 300 million, so we know, and we want to make sure that they stay true to that. And the final one is capital preservation. And capital preservation, the final C, it's an interesting one because when people think of capital preservation, they probably think about cash or fixed income or bonds, capital not deteriorating. We think about it a little bit differently because it's really important actually across different strategies. So if you think about one extreme, a micro cap or a small cap fund, we want that manager to be able to take a very, very large cash position. We saw that with one of our preferred micro cap managers recently that's now hard closed, and that's the Outdoor Alpha Fund. They had extraordinary performance on the back of the COVID rally this year, and then we know in September, October, they took a 35 to 40% cash position. That enhances your capital preservation as a micro cap manager. Then you think about maybe another strategy such as private debt, when managers are taking security over an asset, they're getting to do DD and have pricing power and economic pricing power, and also being able to price those economics appropriately for the risk that they're taking, but often getting security over that asset and still a very healthy high single digit or low double digit return. Two different examples of capital preservation and how it can be used in two very different strategies.